recommendation for Itron Incorporated. After our financial analysis and valuation, we arrived at a one-year target price of $71.07, representing a 30% upside from closing price $54.48 on January 18th of this year. We are pleased with management's continued ability to manage capital effectively and make strategic acquisitions. We have recognized three potential catalysts to drive this increase in their share price. First, the potential growth in global untapped markets. Second, Itron's continued ability to deliver value-generating solutions. And third, the growing demand for the efficient use of resources around the world.
Itron is a diverse information technology company that provides metering products and services to utility companies across the globe. Itron was created by a small group of engineers in Idaho in 1977, with their primary goal being to find better ways to read meters. It is now a global company with locations across the world, but they are still headquartered in the Pacific Northwest. Since 1995, Itron has acquired and partnered with many top firms, including AEG, Schlumberger Metering Services, Acteris, Cisco, SmartSync, Converge, and their most recent acquisition of Silver Spring Networks in 2018. Historically, Itron has been segmented into three operating segments: electric, gas, and water, with their two main product types being smart and standard meters. In 2018, Itron launched a new segment alignment which splits Itron's business into three new segments: Device Solutions, Network Solutions, and Outcomes. The Device Solutions segment is the majority of their current business, but they plan on expanding into the other two segments because they have higher margins and larger growth opportunities.
Itron has an array of products and services in the electricity, gas, water, and networking segments. They also provide hardware such as meters, sensors, and valves, as well as software used in data creation and analysis. They are also responsible for the creation of AMI and AMR. Itron is not opposed to new acquisitions. However, their main goal is to deleverage to 2x net debt to EBITDA by 2020. Their mid to long-term goals are to expand product sales into untapped markets and increase sustainability and resource efficiency. Itron is a leader in the smart meter industry, and they plan to implement their road to a converged network across the globe. Itron is in the IT industry. However, they are heavily reliant on the utility industry, which makes them very unique. Itron, the smart meter industry, has seen substantial growth over the last couple of years, and it is expected to expand on that. There are several factors that drive industry demand, such as the need for renewable energy, the global smart city movement, and global population growth.
Itron is the leader in the utility meter industry, as they were the first to create handheld meters, and they now remain the #1 producer of utility meters. Their top two competitors are Xylem and Badger Meter, which are both US-based as well. However, they have competitors across the globe, everywhere from Switzerland to multiple low-cost producers throughout Asia. The highest industry risk that Itron faces is supplier power. Supplier concentration is extremely low, even single source for certain components, which has potential to slow down production and hurt profit margins.
We arrived at our one-year price target of $71 through a combination of several valuation techniques, weighted for our perceived relevance. Our first method was a discounted cash flow valuation. We used company guidance for this year's revenue and EPS to derive cash flow growth of 8% and a weighted cost of capital of 8.2. Last quarter, Itron provided projections for global growth for demand in each of their segments. So we grew revenues at 90% of their projections for conservatism. Revenue growth should compound as they focus on their network solutions and outcome segments, which are expected to grow globally much faster than devices. This method resulted in a price target of $64.84. We also conducted a sensitivity analysis, adjusting our cost of capital and cash flow assumptions for a 2% more optimistic and pessimistic margin around our base assumptions to create a target price range of $41 to $105 per share. We weighted our DCF method 55% of our total price target because we believe future cash flows are the most indicative of future value, and it allows for the most detailed analysis of changes in assumptions. To provide a more robust picture of Itron's potential value, we also created 3 multiple-based analyses, each weighted 15% of our total price target. First, the historical average PE, which resulted in a price target of $54.61. Next, We examined the EV to EBITDA ratios for competitors Xylem, Muller Water, and Badger Meter, which resulted in a target price of $71.08. And lastly, we looked at the revenue multiples that Itron has recently made acquisitions at. Itron acquired Converge in 2017 and Silver Spring Networks in 2018. The midpoint of their acquisition multiples resulted in a target price of $110 per share. We believe heavy consolidation in the smart meter industry provides an opportunity that Itron may be an acquisition candidate for a larger diversified competitor such as Honeywell. In summary, our confidence-weighted and diverse valuation resulted in a target price of $71 per share, which represents 30% upside potential from the closing price of $54.48 on January 18th.
To further understand the impact of risk and uncertainty within our valuation, we ran Monte Carlo simulations on earnings per share, free cash flow, and adjusted present value. We used cost of goods sold and sales as our dependent variables. After running 1 billion simulations on each model, we found that over 80% of the time, shares were valued at $50 or more in both the adjusted present value and free cash flow models. To begin our financial analysis, we would like to discuss Itron's backlog, which represents just over 50% of their total 12-month revenues. Itron has shown the ability to steadily grow their backlog by securing customer contracts globally to ensure business for years to come. In 2018, Itron saw their gross margin decline 8 basis points, mainly due to component sourcing issues and costs. We believe that these numbers will revert back to 2017 levels and grow 10 basis points per year as higher margin segments, networking solutions, and outcomes become a larger percentage of revenues. Itron's returns appear lower than their competitors. However, this is in large part due to recent acquisitions, and we strongly believe that these headwinds will change as Itron completes the integration of Silver Spring Networks and continues to deleverage. Itron's asset turnover ratios have remained steady over the last 5 years, and they are continually above industry averages.
Itron acquired over $500 million in debt in order to acquire Silver Spring Networks. By Q3 of 2018, Itron has already paid back over $90 million in debt, which is ahead of schedule for their debt repayment plan. Because Itron has continually shown their ability to produce large free cash flows and they are expected to continue growing, we believe that Itron will have sufficient cash to support their aggressive deleveraging strategy. Itron plans to have a leverage ratio of 2 times by the end of 2020. Itron recognizes the importance of decreasing our leverage ratio in order to take advantage of future acquisition opportunities, facilitate future borrowing needs, and be more in line with industry averages.
Itron's executive team has 20 to 30 years of industry experience. Philip Mezzi was promoted from within in 2013 to CEO and has held multiple positions in the company since 2003. Itron's board contains 30% women, which is 5 times the industry average. Itron also has a large presence in their community with their corporate and employee giving, volunteerism, and their educational outreach program. In 2013, Itron was also named as one of the most improved corporate citizens by Corporate Responsibility magazine. Itron has worked to decrease water consumption, electricity usage, and greenhouse gas production.
Itron's main financial risk is their current high level of debt. Their operating risks include factors such as security and adverse publicity. They also face many market risks such as changes in regulations, interest rates, exchange rates, and security. Furthermore, Itron's customers also face environmental risks, as we saw last summer with the California wildfires, which resulted in the bankruptcy of PG&E, which may result in decreased investment in Itron products.
We created a SWOT analysis to further expand on our evaluation of internal and external factors that may disrupt Itron's current business. We wanted to emphasize the major growth opportunities within the smart metering industry. First, the potential growth in unsaturated markets, the constantly changing environmental policies, and the strong push for global smart city adaptation. In conclusion, we would like to reiterate our buy recommendation of Itron at a target price of $71.07, representing a 30% upside. We admire Itron's ability to maintain their position as a leader in the smart metering industry by continuing to make strategic acquisitions and delivering state-of-the-art utility metering technologies. Thank you.
Ten seconds to spare. our judges a moment to collect their thoughts and then begin the Q&A. So, you guys probably saw what happened yesterday. They adjusted their guidance. I guess, so this is a kind of on the fly adjustment I'd ask you to make. What PE multiple were you guys using for the multiple valuation?
It
Around 19.
was, I forget exactly what it was. It was the P from 17.
17? A 17 times multiple or
No,
from
the-
2017?
From 2017.
The one graph or whatever, it just, you couldn't see the left side in
Yeah.
terms of what, just in terms of, sure, it's the projector or
What it
something,
was,
you
yeah.
couldn't see what was using.
You said the average, I guess. So how does, the adjustment in their guidance, how would that impact your valuation?
Yeah, there's a lot about yesterday's guidance adjustment was for the revenue, since we actually were 90% of their initial projections, our revenue estimates weren't actually that far off from what they ended up at, but their EPS was way below. So in the short term, that is obviously pretty concerning. And now, if we adjusted for that, it would be significantly more. And that is a major concern.
So do you think there are some factors within their new guidance that they issued yesterday that don't reflect kind of a normalized earnings picture? Is that why I guess that's pretty meaningful, I guess, and I wouldn't expect, you can't change it in your presentation today, but that was a meaningful earnings pair pullback that they guided for. So I guess, just something to think about.
Yeah, there were lots of little things like 3% higher tax rate we were expecting. But we actually didn't take out any one-time items. We didn't do any normalization at all. So we think that reflects just how conservative our price target is.
And to add to that, they showed that their backlog was steadily growing still, and that they were still on their continued debt paydown structure. So they're still, the positives that they had projected are happening. So the growth is just slow. But
While we're on the topic of guidance and forward-looking projections, the company's talked a lot about supply chain headwinds. They continue to talk about that on their last call. How did that factor into your forward look of the company?
we believe with supply chain and a lot of the current tariffs and things that are going on right now, we believe that it is a fear for them. However, with prices overseas and here, we believe that with as much business as they do around the world, that they don't really need to hedge for that, because we believe that they'll see the effects on both sides of it because they do a lot of business globally.
In your model, how long did you have the specifically supply chain headwinds continue?
We took them out this year.
My question is, oftentimes when companies do large acquisitions like these guys have here over the last 18 months, they often, in future periods, will do what we call a big bath accounting quarter, where they'll write down a bunch of the goodwill so that from a longer term standpoint, the return on assets are higher. What have you guys kind of looked at that and previous companies that have done large acquisitions in terms of the risk that they do that in terms of maybe being a great entry point into buying the stock. Did you guys talk or think about that at all?
I'm not sure if this answers your question specifically, but we looked at the fact that, could you repeat the end of the question, please? Sorry.
Yeah, it's just so lots of times with companies when they do very, very large acquisitions, and in particular when it's intangible assets, oftentimes they'll write those assets down, a couple quarters after they've acquired the asset. So that from a longer term standpoint, they're essentially inflating their ROA from a longer term standpoint. Why do you think these guys may not have a big bath accounting quarter like that?
I think it's important for this company to stay aggressive in the smart metering industry as the major push for smart metering and more efficient resources. I think it's important for them to continue their position as a leader in the industry and try to secure that market share throughout the globe. And I think that that's where they're going to put themselves in a position to be a leader when that takes off.
Kind of extending with that a little bit on the subject of having significant intangible assets. I noticed. So you guys said that you weren't. Are you using GAAP numbers or non-GAAP numbers?
We're using GAAP.
GAAP. Okay. Because I noticed that Itron, in their adjustments there, and especially in 2018 after the Silver Springs acquisition, it looks like they're adding back a lot of amortization. And how do you feel about the idea of adjusting earnings by adding back amortization? Is that a proper reflection of their true earnings power?
We thought we didn't do any adjustments because we felt that those are still relevant and should still be just left alone. And as a company that is kind of a serial acquirer, those are going to come just about every year.
This is actually a pretty hard question, but on their most recent earnings call, they actually mentioned that PG&E's bankruptcy could potentially be a positive going forward. I kind of personally, as an analyst, scratched my head on that one. Do you guys have any idea what would be catalyzing that bankruptcy as a potential positive going forward?
I completely agree with you because the particular problem that PG&E had was not at all related to an Itron type of product. So we don't see how they could think that was like a bunch of stuff caught on fire. This is an opportunity to replace it, unless they're talking specifically about certain homes, individual homes that have smart meters that need to be replaced. But long term, we kind of see that as a negative if they have or maybe might be acquired by a different company, PG&E, or have all these settlement costs that they're not going to have, not going to deploy their capital for specifically smart meters and that sort of infrastructure, but more on the like the transmission lines.
To add to that, though, from Itron's perspective, I think that they could see it as an opportunity where things burn up and they're going to have to reinvest where they're not liable for the insurance costs and replacement of these products. It could be an opportunity for more business for them. But from Itron's perspective, we feel that it's kind of you can look at it from both ways. When natural disasters happen, that's an opportunity for them. But however, we feel that as utility companies are investing in infrastructure and trying to become cleaner and produce more efficient resources, we strongly believe that with this, now a company like PG&E is going to have to invest resources in other places to ensure that that doesn't happen anymore, and maybe not invest in the smart meters.
Sure, yes.
So with Itron's recent new resegmentation from electric, gas, water to devices, networks, and outcomes, the company had mentioned that, which you guys did a great job, I thought, of describing the pyramid of devices, networks, and outcomes. And as you move up the pyramid, the margins change. Margins can grow as you move up the pyramid. How did you take that into account as you were doing your valuation model? Did you look at kind of different valuations for each of the segments, or did you apply the same valuations throughout the pyramid?
Can you see if you can find the slide in the appendix with the red header, the revenue growth? We didn't do, since they didn't, this was before they had any sort of guidance on exactly what those margins were. So we couldn't necessarily do like a sum of the parts valuation. But we did grow revenues by their projections in each segment. And as the higher margin segments grow,
This time. Thank you, guys.
Thank you. Good job, you guys.
Thank you.
Every year